In 1976, Congress embedded a single paragraph into the U.S. tax code, wrapped in language so precise it would take the middle class 50 years to find it. No announcement, no headline, just a rule that has quietly sheltered billions in income from the IRS. And the people who wrote it had no intention of telling you it existed. Augusta, Georgia. April, every year since 1934. The Masters tournament descends on a small southern city, and for 7 days the entire town transforms. Hotels fill, prices triple, and the wealthy homeowners who live near Augusta National Golf Club do something that has been happening quietly for 90 years. They rent out their houses, nice houses, houses that command $10, $15, $20,000 for a single week. They pocket that money, and they report none of it to the IRS. Not a single dollar, because they don't have to. There is a rule. There has always been a rule. And for 50 years you were never supposed to know its name. It's called Section 280AG of the Internal Revenue Code. Unofficially, the people who know about it call it the Augusta Rule. And what it says in plain language is this: if you rent your home for 14 days or fewer in a calendar year, the rental income is completely tax-free. You do not report it. You do not declare it. The IRS does not count it as income at all. A week's rent at Augusta rates, $15,000, disappears from your tax return as though it never arrived. That's not a loophole. That's not a gray area. That's the law, written in 1976 by people who had already figured out how to use it. Now here's what the official story says about why this rule exists. They'll tell you it was a matter of administrative simplicity. That tracking small, occasional rentals wasn't worth the IRS's time, that the rule was practical. Almost mundane, except it wasn't mundane for the people who designed it. The language of Section 280AG is surgical. It doesn't say small rentals. It doesn't say occasional. It says 14 days, exactly 14, which happens to be exactly how long the Masters tournament cycle demands from Augusta homeowners, including setup and teardown. The precision isn't coincidence. In 1976, the year this rule was signed into law, Augusta National Golf Club had 300 members. Their average net worth was in the millions. Congress handed every one of them a tax-free income stream that required nothing more than owning property near a prestigious event. The middle class was not invited to that meeting. They were not consulted. They were simply not considered. Just like that paragraph, the one no one announced was not written for them. But here's the part that changes everything. Here's what you were never supposed to find. The Augusta Rule was never restricted to Augusta. Any homeowner in the country can use it. 14 days of rental income, completely untaxed, no matter where you live or what you're renting for. And once CPAs and tax attorneys figured that out, which took years because this rule was buried, the strategy moved somewhere no one in Congress publicly discussed: business owners. If you own a business and you also own your home, you can rent your home to your own business. You schedule a meeting there, a planning session, a strategy retreat. Your company writes the rental payment as a legitimate business expense and deducts it. You collect the check as the homeowner. And under the Augusta Rule, that rental income up to 14 days' worth is entirely tax-free on your personal return. The business deducts it. You pocket it clean. Both sides of the same transaction working in tandem, sheltering money from the IRS at both ends simultaneously. The IRS has known about this strategy since at least the 1990s. They have not closed it. They have not restricted it. They have not issued meaningful guidance discouraging it. The rule has sat open for nearly half a century, generating tax-free wealth for anyone who knew it was there. Think about what that means. A business owner running a profitable company can legally extract tens of thousands of dollars per year, far more in high-rent markets, completely off the IRS's ledger. The business claims the deduction. The owner keeps the cash. And the middle-class W-2 worker sitting next to them on the train pays full income tax on every dollar they earn. This is not an oversight. Tax codes are not written by accident. They are written by people who already have accountants who have read every word. The Augusta Rule survived the 1986 Tax Reform Act. It survived the 2017 Tax Cuts and Jobs Act. Every major overhaul of the federal tax code for 50 years, and this paragraph stayed untouched. No senator stood up to close it. No Treasury official called a press conference. The rule built for the wealthy remained exactly where it was placed, doing exactly what it was designed to do. So here's what I want you to sit with. The IRS knows this strategy exists. Congress has had 50 years to close it, and this paragraph is still open. The question was never whether this is legal. It is. The question is why they made sure you spent 5 decades not knowing to ask.